When you think back on the stocks you bought, have you ever bought a stock and then it falls immediately, or it grows a little bit and then falls immediately afterwards? And then you wonder, why is it every single time I buy a stock, it falls? It's like I'm the best at picking losing stocks. Well, I've been there and done that too. So if you're in the same shoes, stay tuned because I'm going to be going over a few reasons on why that is happening and then a few tips you can implement to change that. The first reason might be because you didn't read the stock chart, which does involve a little bit of technical analysis. And it's not as hard as you think it is, especially for investing, because you don't have to be as precise as stock trading. At the very basic level, stocks don't move up in a straight line. So it's not like a rocket ship where it just shoots straight up, which is kind of like what happens to cryptocurrency, and that's more like speculating. So stocks move in wave patterns. So it goes up and then down and then up and then down. So when you bought into a stock, most likely you've been hearing that stock has been increasing, because I'm pretty sure you wouldn't have bought into that stock if you keep on hearing that stock is falling, falling, falling. So when you bought into a stock when it's on its uptrend and you didn't look at the stock chart, you might have bought into it right when it's at its tip and it's about to retrace. And that's why right when you buy into it, it might be a good stock, but it's retracing and you just bought into it at the wrong time. It's going to be really useful if you know some technical analysis that can be used for stock investing. For example, moving average lines, Bollinger Bands, how to read the candlestick patterns, how to read the stock chart patterns, for example, how to find the resistance and support lines. So these are things that can help you determine what is most likely going to happen. The second reason is you're buying stocks that you hear are good from a friend, an analyst, or even an expert, but you don't do the research on that stock yourself. So you have no idea if it's really good, but you just base it off of what you hear. For example, there's an imaginary stock XYZ, and I tell you this stock is really good, I'm buying into it, and you've been hearing about this stock in the news as well, maybe newsletters, that this stock is the next big thing and it's going to shoot up sooner or later. So you buy into the stock and then it grows 5% because maybe there's a lot of hype, and then it falls 10%. So what do? Do you hold on to it? Do you add more? Or do you sell and get out because it's a bad investment? Well, you don't know because you didn't do the research. And if it's actually a bad stock and you add more money into it, you're just gonna lose more in the end, because remember, stocks can go to zero and you could lose everything that you invested in it. But if it's a good stock and then you sell out early, then you're gonna regret and say, hey, why didn't I hold on for the long term? I could have made so much money. The reason that's happening is because you're looking at stock investing as gambling instead of as a business. So you're just hoping that the stock will go up and hoping that it won't fall. And if it does fall, or even if it goes up, you have no idea what to do because you don't know why you got into it in the first place, except other people said it was good. Whereas if you treat stock investing as a business, you'll know what type of stock you're buying into, why you're buying into it, so you'll know when to get out and when to buy more. For example, when you're buying cyclical stocks, you actually want to get out when it's at its peak at a previous resistant line, where if you didn't know that, you might be thinking, oh wow, that's a really good stock because it's been increasing so much. Let me get in, which actually is a worse time to get in. Before we go on, I made a guide on stock investing and you can find that in the link below. And if you want to learn more about finances and investing, please remember to subscribe and hit the notification bell. Now let's get back to the video. It's a big misconception that it's really easy to buy stocks because, we just see people click a button and bam, they buy a stock. But it takes a lot more prep work beforehand into actually picking which stock to buy. So it's really not like buying a lottery ticket where we just go to the store, give some money and buy it, which a lot of people are treating stocks that way. Another reason is FOMO, so fear of missing out. So a really good example of this, which isn't related to stocks, but it's cryptocurrency. So when you see like Dogecoin go up, 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 it's really hard to just prevent yourself from getting into it, right? So some people get in when it's super hyped up, when it grew like 100%, and then you buy into it and bam, it falls, This happens in stock too. For example, recently the financial stocks have been going up a lot. For example, JP Morgan, it's been shooting up. And we know not to buy when it's like surging up and we want to wait for a retracement. But when we get FOMO, fear of missing out, It's really discipline that we have to control our emotions and be very disciplined in, okay, no matter where this stock surges to, I'm going to wait until it retraces to a support level before buying into the stock. Along with this discipline concept is also controlling your fear. For example, you did all the research and figured out that the business behind this stock is very good. So when you buy into it and then it falls, you should have the discipline to not sell and just trust your research. And also when it falls, that's actually a good time to buy more of that stock. If you know all the technical analysis, fundamental analysis, how to evaluate stocks, know exactly which stocks to buy, and just know all the techniques needed to be successful in the market, and you don't have the emotional intelligence and didn't train your emotions of fear and greed, then in the long run, you will lose money. And emotional intelligence plays a big factor in being successful in the stock market. And I find that knowing history and reading other successful investors' work helps me build my emotional intelligence and fortitude in being in the stock market. For example, it's useful to study the history of stock market crashes so you know what happened before the crash, what caused the crash, what happened during the crash, and what happened after the crash. And if you look at S&P 500, well, it got through all the crashes and now it's at its highest point. So it means that the stock market goes up in the long run. That helps build conviction. And okay, the stock market might be crashing right now, but I have faith that the stock market is going to bounce and go up higher than before, like it has done in history. And this crash is a good time to buy into the fundamentally good stocks that I want to own. And during the times that I feel fear, I like to go back and study the works of Warren Buffett, Peter Lynch, just to give my mindset a reboost. Another way to build mental fortitude is to start off small and then increase your capital gradually. So you could even start off with just $50, $100 and buy fractional shares. And then get used to seeing $10, $1 losses here and there, and then get used to seeing $100 losses here and there, 1,000, 2,000, 5,000, so on and so forth. Because, for example, if you just see 5,000 right away, you might just freak out and be like, oh man, I'm out. And researching into the business behind the stock you're buying and knowing how that stock plays into your stock investing portfolio helps give you conviction to hold on and even add more shares if you see the stock fall 20% and even 50%. Oh, I love reminding myself of this quote from Peter Lynch in his book, Beating the Street. A successful stock picker has the same relationship with a drop in the market as a Minnesotan has with freezing weather. You know it's coming and you're ready to ride it out. And when your favorite stocks are down with the rest, you jump at the chance to buy more. Which brings me to my next point, where you might be mixing stock investing and stock trading. And yeah, you might be like, okay, yes, I am a long-term investor. But if you think about it, when the stock falls, do you just get out right away? Or when the stock rises and you see like a 20% increase in your stock price, do you just take profit and like, I'm out of here? Well, if you're doing that, that's actually stock trading because you're getting out when you see short-term gain or short-term losses. And lastly, you might not have a stock investing plan. So you don't know what stock to buy. You don't know how many shares of the stock to buy. You don't know at what price to buy the stock at, when to buy the stock. You're kind of just saying, oh, let me see. I like stock X. Let me buy it. I like stock Y. Let me buy it. I like stock A. Let me buy it as well. And that doesn't work. One way to invest is to first figure out what stock to buy, how many shares of the stock to buy, at what price you want to buy the stock at, and then add that stock into your watch list. Then when the stock retraces to a support level that is close to, at, or even below your buy point, you can start slowly buying into the stock. It's kind of like buying clothes. So when you find a shirt that you like, you add it into your shopping cart, wait until it goes on sale, which might take weeks or even months before purchasing it. I feel like a lot of things that I said above happens because society kind of advertises that stock investing is very dangerous and we should just rely on the experts. And the news kind of makes stock investing like gambling, you know? It always says, oh, the stock is falling, the sky is falling, and oh, this stock is gonna be the next thing, that stock's gonna be the next thing, when it's really the opposite. I mean, rarely do I see stock investing concepts talked about widely online. And I think that gives us the concept that stock investing is like gambling and we're gonna suck at it anyway, so might as well not try. When in reality, if we learn the right techniques, the right knowledge, develop the right mindset, and put that into practice, little by little, it'll get easier to earn money investing in the stock. And it's not as hard as we initially thought it would be.